Good afternoon, everyone. Hopefully you guys can hear me. My name is Jesus Nava. I'm the Director of Client Training and Education for TradeStation Securities. I'm very happy to see everyone here. I hope that everyone is relaxed and you're ready for some great information on options. Today, we're going to talk about condors and butterflies in options trading. It's an interesting topic, to say the least. So I'm glad that everybody took time out of your schedules to be here and learn a little bit about options trading. Today, we have a guest speaker. His name is Brandon Wendell. If you've been to our series of options webinars, you probably know him already. A great educator and has a lot of expertise in the options world. So we are very glad to have him here. Before I pass the microphone over to him, I do have a couple of announcements and some disclosures to go through. Keep in mind that every symbol and idea that we talk about is for educational purposes only. Also, that active trading is not suitable for everyone, especially when it comes to trading options, which carry a higher degree of risk. Please be aware of all these risks and make sure that when we talk about examples, these are no guarantee of future results. Another thing to point out is that Brandon Wendell is not affiliated with TradeStation, although we love to have him, and he's our guest today because of his expertise. His ideas and methodologies are his own. If you have any questions about the disclosures, go to www.tradestation.com/important-information. So welcome, everyone. I'm going to pass the microphone over to him. And before I do so, I want to talk to you about what we're doing at TradeStation recently. Since January, we have been working on an options education center. Let me just show it to you here on the screen for a moment. Today, we're going to be talking about condors and butterflies, and the basis of this webinar is this article that already exists in the Options Education Center. I'm going to share the link with everyone here in the chat. Make sure that you have access to the chat, because I am going to be sharing not only links to specific articles and workspaces for you to download, but I also want you to come here and explore all the different articles that are available on all different option strategies, bull call spreads. We have articles on index options, futures options, iron condors. So there's a lot of educational value here, and I want you guys to visit and explore. So thank you guys for being here again. I'm going to mute my microphone and pass the microphone over to Brandon. Brandon, the floor is all yours. Thank you for joining us today.
All right, well, thank you very much. Hopefully you can hear me okay. I apologize, but I don't know what's going on with my camera here. I got a kind of weird glow going, but I'll
I thought it was intentional. Blue, like a PlayStation blue.
Yeah, I've moved and I'm getting everything set up at my new place, and a little bit of a growth curve here, I suppose. Anyway, let me go ahead and make sure I can share my screen as well. And let's see, screen one, we're good. Oops. And all sorts of fun here. There we go. Come on. And now it should be screen sharing. Great. Yeah, so if you're not familiar with who I am, again, as Jesus mentioned, I'm just a guest here. I'm not employed by TradeStation. I'm a trader and trading mentor. I also attained the designation of Chartered Market Technician, which basically means that I've got a lot of experience in technical analysis and analyzing the markets. I came through the process, started as a retail broker, then moved into back office operations where I did trading for the brokerage. They call it agency desk operator. And gave that up gave up all my licensing really. And now I just simply trade for myself and mentor and teach others, about the markets and what they can do in those markets. So anything I'm looking at here in the markets, by the way, is just from an educational standpoint. I'm not giving any recommendations about the markets or any, I'm not telling anyone to buy, sell, or hold anything in particular. It's just, again, education that we're doing. So that's a little bit about me. And of course, if you have any questions, it's good to see you as well. Thank you, everyone. And I've been a student of mine as well for a while. Great. Well, what we're going to talk about, as Jesus mentioned, is condors and butterflies. And this is going to be a little bit different than what you might have heard before, because in the previous webinars that you had through TradeStation, they were talking about iron condors and iron butterflies, and we're going to be discussing condors and butterflies. The difference is not just the word iron, but when you use the word iron in regards to options, you're referring to a combination of using calls and puts. When you create butterflies and condors, you are simply using one or the other, either calls or puts. And it's a four-legged strategy. So there are reasons why you might want to use one over the other, and we're going to go into that as well. We'll talk about the fundamentals of those, the structure, the risks involved. We need to know the risks. Everybody always likes focusing on, oh, wow, how much can I make with this? But really what's most important is what kind of risk are you exposing yourself to? And part of the reason why we would create spreads, meaning we open up multi-leg options, is because we are trying to adjust the risk or change our risk exposure. When you trade a single leg option strategy, you have to accept whatever risk that particular option has. And, when we go into these fundamentals, let me just go ahead and show you. I've got TradeStation open right now. By the way, this workspace that I'm going to be using here, I didn't mean to do that. This workspace that I'm going to be using is available to you as a TradeStation customer. Basically, you can go to that Options Education Center that Jesus mentioned just a little while ago and give you the links to, and will again, I'm sure. And you can download these workspaces that were created for you, along with instructions about how to use them, what you're looking at, all sorts of stuff right there. So anyway, this workspace, I don't know why my bottom line is still popping up there, but yeah, let me close a few things out. There we go. No, maybe not. Anyway, what I was trying to show you, and I keep failing, there it is. It's called Condor-Butterfly, and that's the workspace that we can use to identify some of these opportunities. I'm also going to be using in the apps, there we go, the OptionStation Pro, which will take just a moment to load up. And then hopefully my taskbar will disappear again and give us the full screen. Even if it doesn't, we're still okay. But basically what I was getting at here, once this opens up, is if we create a single leg option, when you either buy or sell that call or put, it doesn't matter which one, you are basically accepting risks in the markets. It's the same as when you open any position. You always accept risk regarding that particular position. So let's go here to options. As you can see, I was playing around with it yesterday a little bit, but I have Amazon showing right now. It really doesn't matter. I'll click on Amazon, buying a call, and we'll go to analyze. And I have to get rid of this condor that was currently there now. And now we're just looking at that one option, buying the call, 167.50 strike. Now, what risk do we have? Obviously, if we're buying an option, our risk is we could lose 100% of what we paid for that option. But what is influencing that risk? Well, the influences are things like delta, which is directional move of the underlying security. Basically, our risk measurements when it comes to options are twofold. One, we have risk of the underlying security doing certain things. And number two, we have the Greeks, which are risk parameters that define what's going to influence that premium for a gain or possibly a loss when it comes to our options trades. So basically, you're looking at delta, that's directional risk. We have a positive delta, so we want that security to go up in value, so that way our option would also increase in value based on that delta ratio. We have theta, time value. Well, right now we have a negative theta because we purchased an option, so therefore we want time to not really go very fast and erode our option value. Okay, this happens to be a sim account right now that I'm using just for, it doesn't matter. It's live data, live market data. We also have Vega, which is volatility risk. So we have risk from volatility, direction, and time, and there's other risks as well. I can also look at gamma, and we can look at rho. Those are other ones, but I'm just going to focus on those three. Now, if I want to control that risk and change the way I face risk or what risks really apply to me in that position, I can't do a whole lot with this particular option just by itself, other than Well, I could change the deltas by choosing a different strike price. I could change the thetas by using a different expiration. And I can also change the vega by using a different expiration, believe it or not. The vegas will change and the volatility exposure expands the longer you go until expiration. The theta declines in value and exposure the further out you go in expiration as well. So they're kind of opposite of each other. But one of the easiest ways to not necessarily eliminate, you can't eliminate risk, but to control and maybe manage risk better is to just simply create what's called a spread. So rather than doing just one option, we add another or more. You know, as I mentioned just a few moments ago, we could do a condor or butterfly, which is actually 4 legs. I'll start off with just a 2-leg strategy and compare this by going back to options. And instead of just buying the 167.50, perhaps we were also going to sell the 175 at the same time. And let's compare those two. Don't worry about the chart at the top. That's not really what we need to focus on yet. Oops. Delete the price slices. There we go. Let's just focus on the bottom here. And you can see, again, max loss. This is the single option. This is the spread. Here's delta for this single option. Now, look what happened to the delta for the spread. By doing 2 options, you have what's called the anchor leg, which was the same on both. We're buying a call. Okay, that anchor leg typically drives drives profit when it comes to your trading. Then any other legs you start to add are what are called the offset legs. And the offsets are used to manage risk. Okay, can not necessarily eliminate, as I said before, we can't do that, but we can neutralize or manage risk by using offset legs. Well, notice the delta, the directional risk, dropped from 59 to 23. Now, you might also realize that whenever you reduce risk, you reduce reward. You can't have one without the other, right? When you buy insurance, you are reducing risk and you're going to reduce your reward because you have to pay for that insurance. Same thing happens when you're buying options and paying for the premium. Well, look what we did to our Vega. Our volatility risk goes from 16 down to 0.63 or 6.1. It keeps, markets are moving. Our time risk went from -12 to 1.2. So by adding these extra legs and creating spreads, we are making an attempt to control the influence of time, direction, and volatility on our premium and control some of the risk values that happen and some of the things that will influence whether we win or lose. Not necessarily, I'm sorry, I take that back. It's not whether we will win or lose, but how much we will lose if we are wrong. That's what risk management is, controlling the amount of loss that you suffer in your account if you are wrong. You know, if you can control whether you're right or wrong, please let me know, because I've never been able to figure that out in the markets. So we're going to talk how we can do condors and butterflies, create a structure. As you see, it's going to be 4 legs that help to adjust the risk and manage the risk influences on our positions in the markets while still attempting to profit. Condors and butterflies are typically credit spreads where we're going to attempt to seek profit from time decaying and or volatility dropping. So, as I said, we need to understand the risks and reward. And one of the best ways that I found as a trader and even just analyzing trades to create risk management is by using a spread or multi-leg strategy over a single leg strategy. And that's why we're kind of focusing on that. So hopefully that makes sense to everyone. I'm keeping an eye on the chat. So obviously if you have some questions, let us know. What appears to be different in sim trading account? The only thing that should appear different in a sim trading account would be that the orders might get filled faster because it's a computer simulation as to whether or not you have someone on the contra for your trade. So you may have an easier time getting an order fill versus live. And the orders and the management of the win or loss is only housed on your computer rather than actually going out to the market and making a transaction with someone else. For the most part, what I've seen using a sim mode to practice, there's one other big difference I'll mention in a moment. But for the most part, technically and visually, what you're seeing on the screen between a simulated account and a live account should be very, very similar. And if it isn't, that's a problem with your program or your brokerage. But for the most part, what you're seeing here is live market data. But when I place the buy or sell button, it's going into a simulated account, meaning it's not sending the order out. Now, the other big difference between simulated and live trading is emotion and psychological. If I lose money in a simulated account, it doesn't bother you as much, does it? Because you just hit reset. If you lose money in a real account, things go a little differently, don't they? So those are the big differences, but it's not really much else as far as the difference there, especially when I'm using this TradeStation platform. Like I said, I'm looking at live market data, live information, and all it does, sim, I can double click on that and log into a live account if you wanted to. Be the same. So we're going to talk about this and practical application. Again, I'm going to kind of walk through some of the steps of executing these. As I mentioned before, you absolutely can practice and utilize this exact setup that we're using by just going out to that website that Jesus had mentioned just a little while ago. If you go out to TradeStation.com and the Options Education Center, I think it's opening up my browser now. There it goes. It's a little slow. Yep, nope, I didn't do it right. Missed it. There we go. Now I typed it correctly. So under TradeStation, you can just go to Learn, Options Education, and the workspace is available. You would just, and actually the recordings of this webinar will also be available as well, and a bunch of others. There's a lot of education there. So not going to focus too much on that. Let's continue on with our discussion and stay on topic here. And let's see, what are condors and butterflies? Well, I kind of mentioned they're basically spreads. And they're multi-leg option strategies, and they're typically used when the markets are neutral or an individual security. You can trade these options on stocks, you can trade them on ETFs, you can trade them on indexes, and you can trade them on futures. Recently, the CME did a workshop with the Options Education Center. Sorry, the CME did a workshop with TradeStation, and that's posted again in the Options Education Center here for TradeStation, where they were talking about options on futures. There's a lot of different things you could do there as well. So analysis max loss is very different in sim. Okay, I'd have to take a look at that. I'm not sure. Anyway, what we're looking for is an opportunity to profit, as I mentioned, from prices going nowhere, staying either within a range or relatively quiet, whether it be future, index, and etc., stock, ETF. So this is a 4-leg option spread where we're either going to use all calls or all puts. So condors use 4 different strike prices. Butterflies, however, only use 3 different strike prices. You can kind of see from what they call the risk profile right here. With a condor, you have 1, 2, 3, and one's hidden, but there's 4 little corners or angles. Those are the different strike prices. In a butterfly, it looks more like a triangle. So you have 1, 2, 3 angles. Those will be the 3 different strike prices. Okay. So to create, let's say, a call condor, okay, what you would do is basically combine 2 spreads. That's all it is. So you would create an in-the-money bull call spread. And a bull call spread would be buying a call, selling a higher strike call, and that's done below the current market price. Now, one of the things you have to realize with these options is that you do have what's called risk of assignment. When you sell an option, you are at risk of having that option assigned, meaning you have to follow through on that contract. Buyers have rights. So when you buy an option, you have the right to exercise that contract and either take delivery or force someone to take delivery from you. When you sell an option, you assume an obligation. So creating this call condor below the current market price in the money, that short call, which is this one right here, if the current price is above that, somebody could assign that call. The buyer would exercise, you would be assigned as the seller, right? Meaning you would have to sell stock at that price, even though it's currently at a higher price. Well, the nice thing is that because you're doing a bull call spread, you do have a limit on the risk. The long call does offset some of that risk of the short call. But at the same time you do that, you're also going to be doing an out of the money bear call spread, meaning you sell a call out of the money above current price, and you buy an even higher out of the money call. You do that in order to collect some premium. Okay, so typically a bull call spread is a debit spread. A bear call spread is a credit spread. You're kind of combining the two, and you're doing this overall for a net credit. So a call condor is done for a credit to collect premium in the anticipation that prices will stay between the two strikes that you sold. The options would expire worthless or out of the money, the real term, and you get to collect the premium minus any fees or commissions you had to pay. So the underlying, I basically just said that the underlying price is expected to stay between the two short strikes. And the overall position is collecting premium. It's a credit spread. The maximum profit you could possibly gain when it comes to trading a credit spread is the premium you collected. You cannot gain any more than that, right? However, the maximum risk, because we are limiting it, we are basically doing two spreads rather than just selling two different options as a spread. We can also buy two options to limit that risk. We basically have the risk limited to the difference between the two strikes, the one we bought and one we sold. And by the way, before I go any further, that's assuming that the difference between these two are the same. So let's say we bought a 40 strike, sold a 50 strike, sold a 70 strike, bought an 80 strike. That means the difference between 40 and 50 is 10 points or $10. The difference between the 70 and 80 is also 10. You can create what they call broken wing condors, where the difference between one leg, the long and short, is different than it is on the other side. Okay, that's when you have a particular bias in direction, because what will happen with this, remember we were talking about some of the risks, okay? And then you create one. Again, as just as an example, I'm not trying to do any pricing here to see if it's a great trade opportunity. All I'm doing is just getting an example. So let's say we're looking at Amazon and we want to create a condor. First of all, we can go ahead and create a condor by choosing spread condor, and it'll select prices for us. I prefer to just leg it in myself and choose the legs individually. It just, right now I'd have to do a little bit more filtering to get the certain strikes that I would like. So personally, it's your choice how you want to do it. I keep it as single. I do have to remove the ones that I currently had there. There we go. And if you hold down the control key when you select either the ask or the bid, you could start building leg by leg. So let's just, right now, the price is right around 170. We'll assume that that's where we're expecting it to stay, between 160 and 180. So I can sell the 160 call, buy the 155 call. That's one side. Then I go above 170. Let's say I do 180 and I'm shorting that. And then 185. And notice it automatically recognized that as a condor. There we go. So what does it look like in the risk profile? Go over here, actually do this real quick. There we go. We get rid of that menu bar at the bottom. So get rid of our other options that we're not playing with right now. And the risk profile looks like this. There you can see that is the risk profile for a call condor on Amazon. I am buying a bull call spread with the 155, 160, but at the same time, I'm also selling the bear call spread 180, 185. Okay, so I have a 20-point spread, and my intention is, or my anticipation is, that the prices will stay between 160 and 180, the two strikes that I sold. until the expiration of these contracts. If that happens, I get to keep the premium that was collected. Okay. However, if it goes outside, well, things happen, obviously. I would start to lose. There are 2 break-even points. And before I go there, just to show you the maximum risk right now is going to be these difference between the strikes on one side. Remember, both of mine are equal. So it's only $5 between 180, 185, 160, 155. It's also $5 minus the premium collected. So in this case, it looks like I'm collecting $144. And because it's, remember, each option is 100 shares, it's $500 minus 144. My maximum risk is $356. But if I did what's called that broken wing, watch what happens. Let's say we do 150, 155. Notice the distance is higher on this side. It's 10 points versus 5 points on the other side. Well, it changes my max profit. It also changes max risk as well, because it's the difference, again, between one leg, whichever one's larger, minus the premium we collect. Okay. So will the graph show the probability of success? Not necessarily right here, but there are ways that are, well, the quickest way to estimate the probability of success would be to look at delta. It's not actually the most accurate way, but one of the things you could do is taking a look at delta. Delta is used for multiple things. One, it's used to tell you how much the option premium is going to move in relationship to the underlying security. So if the underlying security moves by $1, the delta tells us how much our position's premium should change. It will not move 1-to-1 unless the delta is 100 in this case, because that's showing the entire position. You can see my delta is quite low. Why? Because it doesn't matter which direction prices move. I want this to stay pretty much in the center. Let me change this back from the broken wing to the regular call condor. There we go. So now everything's even. And you can see that I've got a very small delta. The closer you are to 0, the more neutral you are in direction. If you have positive delta, you want prices to go up. If it's negative delta, you typically want prices to go down. Therefore, I have a slight bearish bias here with a negative delta, but it's relatively small. Okay, now the other thing that delta is used for is a hedge ratio. And I'm not going to get into that right now. That's something that we'll talk about probably in the future. The third thing that people often use delta for is the probability of that position finishing in the money. So right now at 1.67, somebody could say that, you know, there's only 1% chance of this finishing in the money. Now, it's not exactly the most accurate way of doing that, but there are things you could do. You can even take a look right here, out of the money, 2 standard deviations, and use some probability measurements there. And there are other tools you could use in TradeStation to kind of identify probability of where prices will likely be in the future. There are actually some visuals you could do as well. I know there's a study. And again, I'm not going to go into teaching all these studies. There's plenty of help things. And actually, I think there's masterclass that Jesus runs that goes over a lot of these different tools. But right there, probability maps, normal distribution. You can actually project that into the future on your chart by adding space to the right to give you an idea of where prices are likely to be in the future. Okay. So max loss sometimes shows positive. Not sure how that would be. Should not, if it's done correctly. My max loss is the difference between, like I said, the 2 strikes minus the premium that I collected. So I can't collect more premium than the difference between those two, most likely, just based on market values. And let's see. Well, we'll talk a little bit more about some of these other things. Okay. Max loss says 0, and the analysis chart shows positive in the sim account. No, my sim account showing max loss right here. If it's showing 0, then it may be something that was added incorrectly, or it maybe have multiple positions that are being analyzed. So getting back to the call condor, I mentioned the maximum profit is the premium collected. I just want to make sure we continue on with this. The maximum risk is the difference between the 2 strikes minus the premium collected. And there's two what we call break-even prices. You'll notice there's a bit of a time value going on here. This is the yellow is representing what happens when the options expire. The blue line is based on a time in the future. And what will happen is the closer we get to the expiration, the steeper that risk profile will become because the time value is wasting away. Remember, we have time value, we have positive theta, meaning every single day we own this position, we get to keep more of the premium because the value of this position will start dropping. We originally sold it to open. We want to be able to buy it to close or allow it to expire. If we have to buy it to close, it would be much more beneficial to buy it at a lower price, right? We sell things that are expensive, buy them back cheaper. Okay. So the break-even prices are based on the two strikes you select to short. You have the lower short strike minus the premium and the higher short strike plus the premium for the two break-evens. And you can see it on the chart as well, right? If we were to go, let me change this for the graph because right now it's representing some random times. Actually, no, it's halfway to expiration. We'll go current and expiration. So right now, the blue is our risk profile. Okay. Our break even is pretty much non-existent because we are at a loss. We have to pay, or not pay, I'm sorry. We're entering in this position right now. And unless the value of these, the spread goes down, we'll lose money right now. But remember, time is going to go by. So with the theta decaying, we're going to be gaining $4 in this position every single day. We're collecting $144 in premium currently. However, the difference between the two strikes minus the premium, well, at the expiration, that's our break even. So we have a difference between 155 and 160. Remember, that's a 5-point difference. We also have 180, 185. That's 5-point difference. We're collecting $1.44. This is showing times 100. So 5 minus 144 is 356. Well, if you take the 160 strike, subtract $1.44 premium we collected, there's your break even. If you took the other short strike, 180, added $1.44, well, there it is, 81.44. Actually, you can do it with price slices. So 0 DTE, 181.44, 0. That's break even. And if we did 160 minus 144, what would that be? 158.66. Is that right? No, I did that wrong. I'm off by 10. Almost had the math right in my head. There you go. 158.56. That's what it was, not 66.56. See, those are my two break-even points. It's the strike price we sold minus the premium collected, strike price we sold plus the premium collected. That's all. At expiration, if prices are anywhere between those two break-even points, there is some profit to be made. The maximum profit is only achieved if these options expire with the underlying price between the two strikes we sold. Okay. That's all right here. SPX. Okay, well, I'm not going to look at that right now. We'll look at some others, right? And I will look at some of the SPXW because I do like doing condors and butterflies on those as well. And I did mention this, the assignment risk is always there until you close or buy to cover a short option. You always have the assignment risk on those options, any short option. So creating a put condor, pretty much the same. We're going to be doing a bull put spread and a bear put spread together. That's all. So we're doing an out of the money bull put spread below the current market price and in the money bear put spread, as I just mentioned, above the current price, the risk is a little higher for assignment because we are choosing one in the money option. Okay. I just randomly chose that security I mentioned. Okay. So I'll get to that. Actually, that is a good thing to bring up, Kevin. When you're trading options, there are two types of options you have to deal with. Most stocks, ETFs, and even futures, not all of them on the future side, but many of them are what we call American style options. American style options, the buyer has the right to exercise at any time. Therefore, sellers have the risk of assignment at any time. However, yes, exactly. That's where I was going, Ken. What Kevin was mentioning is that the index options like SPXW.X, that's the symbol on TradeStation, those are European style options. European style options cannot be assigned or exercised until expiration. So if you're trying to do day trading using condors or butterflies, some people enjoy doing it on SPX versus doing it on the SPY. Why? Well, because you do not have early assignment. That's it. What is the margin requirement on these? Based on the brokerage, but typically, and again, you have to check with TradeStation Trading Desk to make sure, because I'm not a representative of TradeStation, but typically the margin required to be able to open one of these positions is simply going to be whatever the maximum risk is. The difference between those two strikes that you bought and sold, whichever's largest, and obviously if they're both the same, it's one side minus the premium you collected. So remember, if I did that 5-point spread on the calls and I collected $144, my risk was $356. That's the margin required to open that position. And on TradeStation, actually, they have it on the website too. I know that because I've seen it before. When you go into trading products, I think it might be under pricing margins. Yeah, option margin requirements. There you go. It's right on the website. It's pretty open. But again, verify with your trading desk. Check to see what level options trader you're allowed to, or trading you're allowed to do. But you'll see credit spreads and even the condors, basically the same thing as there it is, short butterfly call spread. It's a requirement of the bear credit spread. So it's the same as one of those legs. Okay. And it should be, there it is, condors, short, condor call spread, condor put spread. The credits are the requirements you would have on the spread, which is the maximum risk. That's all. Okay. Again, I don't know, Tony, about that question. You have to talk to TradeStation. I don't work for them. All right. So underlying price, again, we're doing this because we're expecting it to stay between two short strikes. And the overall position is open for a credit, as I mentioned before. Maximum profit is the same. Maximum risk is the same as well. It's the difference between the two strikes minus the premium collected or plus, depending on, I'm sorry, maximum risk is minus the premium collected. The break evens, either the higher strike plus or the lower strike they sold minus. So this is identical to what we did with the call. It's just using puts instead. Now, there's also in the page I mentioned, let's see, where is that? Options education page, there are articles that are in there that talk about why there may be some advantages, and there's a video as well that's in there, talks a little bit more about the advantages of using either a call or a put right here, multi-leg option spreads explained. So we click on that page, it's active right now. And this is where you would find the workspace I was just using. I'm going to go through it a little bit more. There it is. But there is a video that explains a little bit more about this and the articles. But there's a piece that is in there that I voiced the video, so I know it's in there. But I talk about the reason why you may want to choose a call condor versus a put condor or vice versa. And a lot of it comes down to, again, having a bias of one direction or the other, because you'll have a slight positive or negative delta. But for the most part, these are neutral strategies. We are looking for prices to stay relatively quiet within a range. Okay. I do consider implied volatility. I'm going to get to that, Maurice. I haven't hit that yet. I'm just talking about the basic structure of these right now and some of the influences when it comes to the risks. and we'll move on to some of the more advanced things in just a few moments. So a butterfly, the biggest difference between the butterfly and the condor is that we're using 3 strikes instead of 4. With the condor, remember, you had 1, 2, 3, 4 strikes. You're doing a buy, sell, sell, buy. Here, the difference is instead of looking like kind of a pyramid, not a pyramid, but a plateaued shape, now we have a triangle or a pyramid. So we're using the bull credit spread and a bear credit spread put together using the same strike price for the shorts. So the reason why people may choose a butterfly over a condor is that it's steeper. That steepness means that you have potentially higher profits. However, the break-even prices are closer together. And there's one other thing that also happens too, really. One is you have higher assignment risk because unless prices expire or finish right at expiration at the short strike, one of those is going to be in the money. So often what will happen with butterflies, the premium that you collect could be higher than a related condor, but you would most likely need to close out the position before you're assigned or before expiration. And it depends on, you know, what commissions you have to pay, if it makes it worth it to do that butterfly versus the condor. Okay. So that's what I mentioned. The only way you get maximum profit on a butterfly is if the underlying security is exactly 100% at the short strike at expiration. If not, if you're 1 penny above or below, one side of that butterfly is going to be in the money and it's going to be automatically assigned. That's just the way it is. So to avoid that, you have to close the position prior to expiration or assignment. Period. So let's talk about putting these together and actually doing them. Actually, before I do that, we can just simply adjust. Right now, we have a condor, right, on Amazon. Well, instead of using different strikes, and by the way, the maximum profit right now is $144, isn't it? All I have to do is change the short strikes. Let's say we make them both 170. Oops, I'm the wrong way here. Sell. Oh, it won't let me do it, will it? Because I have to remove. That's what I have to do. I have to do it this way, don't I? There we go. Let's remove the 180. And now I will sell 2 of the 170. There we go. Now analyze. Get rid of the old condor there. And there it is. We're buying the 155, selling 2 of the 170s, and then buying the 185. And notice what happened to our max profit. It went up. It's not $144 anymore. It's $808. And our max loss has also changed. It's not 300 something, it's 600 something, almost 700. So we've greatly increased the potential reward, but we've also increased the potential risk. We've changed our theta. We actually should keep both of them there. Let's try that just to compare the two. Again, I'll go back under trade. There we go. And remember, I was using the, what was it, 155, 160. I just want to show you how they look compared to each other. 180, 185, condor. And that was the call condor, right? So we have the butterfly condor and the call condor. Don't worry about that shape right now. I just want to show you the difference. Again, max profit 808, max profit 145, max loss 692, max loss 355. And the other thing is the type of risk that we have exposure to. We had exposure to delta, right? We have a negative delta both on the condor and the butterfly. So we profit if prices drop a little bit, right? Negative delta means the value of those options goes down with the price moving down as well. If prices would move up, that premium would also move up against us a bit. Look what happened with our Vega. The Condors, this one, 677, we've increased our volatility risk, right? We have a negative volatility risk, 1548 versus 678. So we're getting a bit more profit. Remember what I said before, you cannot have more profit without more risk. So by gaining that much more profit from what, almost 4 times as much profit, we're also increasing our risk in volatility, and we're benefiting more from time decay. So we're getting a little bit better theta. Instead of making $4 per day on a position for time decay, we're getting $9 per day. So there are some advantages and reasons why to choose the butterfly over the condor. But one of the main things you have to realize is that you are increasing your risk of assignment, because one of those two is going to be in the money at the expiration or even before, until you either close that position or those options expire. And it's almost, I shouldn't say impossible, but it's very unlikely you're going to get the options expiration and the underlying securities expiring right at $180, or in this case, 170, whatever the short strike was. Okay. Would you need to hold at least 1 day to avoid status as a pattern day trader? It would depend on what you're trading. That's a great question, Maurice, because when you're trading equities and options on equities, yes, you have pattern day trading rules that apply to you, wash sale rules that apply to you. When you're trading options on futures or futures, no, doesn't apply. If you are trading options on indexes, maybe. And what I mean by that is if you enter a position and close, you buy and sell the same security within the same day, whether it's a stock or an option on an index, yes, you could have that where you have to worry about pattern day trading. But if you are trading condors, the goal for most of those, not always, but most of the time, traders enter that position, meaning they sell to open, but they never buy to close. They allow the option to expire worthless. If the options expire worthless, technically you never bought to cover, so it's not a pattern day trade. So if you open a position and close it or get stopped out, that's a close. Yes, it does go against you unless you were trading options on futures, because futures and options on futures do not have pattern day trading rules applying to them right now. You know, it may change again, talk to your trading desk, make sure, because I don't work for the brokerage. I don't know how everybody handles everything, but my understanding of it, the way it is, yeah, you can avoid that by either allowing the options to expire. But if you were exercised and must need to close, or you hit a stop loss, it could become a pattern day trade. Yeah. Okay. So we're looking to do this. I'm gonna check something real quick. Okay, we got time. Good. Likely conditions. I've been saying this over and over again. We want to find securities that are kind of range bound. Now, we are also selling options. So answering the question before, yes, implied volatility is something we want to focus on. Implied volatility has a big influence on option premiums. If you would like to collect more premium, which as a seller of options, you do want, then you would like to have higher implied volatility. But we want implied volatility to potentially drop in the future. Remember, looking at our positions, we can see where our risks are, right? Delta, that's directional risk. Vega, volatility risk. Okay, we have a negative Vega when we're selling these positions. That means if volatility goes up, it hurts our position. Let me show you. If I use a price slice, and I'll just use the Condor as the example right now. There it is on the Amazon. Basically, I'll say, okay, we're going to pin this at last price. There we are. And we're not going to change anything else. Go back to where we are right now. Current days till expiration 23. And I picked that as a random date. Don't read into that too much yet. But watch what happens. If prices change, let's say, well, where were we? We're at last price. Sorry. 169.70. Let's say we go up by $1. 170.70. Now we had a small loss, $3. Not a big deal, right? Because we had very limited delta for this position. we have limited exposure there. But volatility can move. What if we guessed wrong on volatility? And I'll put this back to the last price. And instead of volatility going down, it went up. Maybe we had a quick drop in price and we went to 162. Well, we're not outside of the range of where we want to be for our strikes. But if volatility went up, let's say 8%. Oh, I did negative, not up. Sorry, that was a profit. There we go. Look what happened. Prices didn't move anywhere, but volatility increased. Now we lost 50 bucks on the position. Remember, our max profit is only $145. Well, as long as we expire within. If we are forced to close this early, we could accept a larger loss than we wanted to because the volatility adjusted on us. And volatility can change quite rapidly throughout the day, especially on certain securities. Why not close at 345 to avoid the expiry fee? It depends on who you trade with and how you trade, whether or not you're going to have a fee for expiration. Yeah, I'm not familiar with the $14.95 expiry fee or the commissions. Again, it's going to be different depending on who you're trading through and your relationship with that brokerage. Institutional versus retail traders and the pricing that you have. So the strategy is typically applied when implied volatility is relatively high. It doesn't have to be spiking or everything crazy, because remember, the higher the volatility currently is, the more likely you are to have big price swings. And the Condor or Butterfly typically profit from prices staying stable, but we would like to have relatively increased volatility, expecting it to decline soon. So higher implied volatility, yeah, gives you a little bit more. And choosing expiration. So getting back to the question somebody had earlier, why did I choose 23 days out? Well, when I am looking at credit, I would love to collect as much premium as possible. But the problem is, the further out in time you go, okay, remember, I didn't mention this. I mentioned in another class I was teaching last night. The further out in time you go, the more risk you have in volatility. So if you're doing shorter term options, you don't get as much premium. It says right there, longer term options give you more premium because you're basically selling time, and you're accepting more premium because there's more time for the prices to move against you. The other thing that happens is, as you go further out from expirations, the further out you go, the more vega risk you have, the more volatility risk you have. Okay. And you don't get as much of a benefit from time decay, because time is not linear when it decays in a curve. And the fastest time decay occurs within the last 30 days till expiration. And that's why a lot of people like, zero DTE. I was just about to mention that exactly. If you do zero DTE, you can go ahead and trade that with all that volatility dropping off at the end of the day. If you go back, as I mentioned before, there's a bunch of webinars that were recently done in the Options Education Center, recorded. There was one on zero DTE options that you can watch, and you'll see how the Greeks are affected. They talked about that in the webinar. It's pretty cool. I watched it. The melting ice cube, you got it. So prior to earnings, well, here's the thing. Yeah, when it comes to earnings, there are different strategies to apply. A lot of people misapply some of the strategies because they don't understand earnings. I know that what's his name, David, with TradeStation, was doing some workshops on earnings as well and how to be trading those. I'm not sure if that should be on the schedule coming up, I believe. Now, make sure I say it and see it correctly right here. Again, events. But yes, you might want to have an expiration prior to the earnings date. However, putting this on a Condor before an earnings date may not be the best strategy, because the options volatility goes up into the earnings. Remember, we want the volatility to be dropping. If you do it right at the earnings and then the volatility collapses, it might be a little bit better. But right here, there's a calendar. And there you go. Channeling potential zero DTE strategies. That's the one I was referring to before. That was a previous webinar. And anyway, you can take a look at the schedule. There's a lot of different webinars coming up. And I know there's one coming up on earnings. So you just have to look. I'm not going to do it right now. I want to focus again on this. So choosing expirations, when you choose longer term expirations, you have more volatility and assignment risk, and you don't get as much time decay. Shorter time frames decay faster, especially 30 days or less. So I often, when I'm looking at these, will opt for shorter expirations, 30 days or less when I'm selling, kind of as a rule of thumb, maybe 60 days at the longest. But you'll see the time decay, for instance, right here on the 170 at the money call, that's 12 cents per day right there. And this is on an option that expires in 23 days. Heck, you look at 9 days till expiration, 170, now we're at 19 cents every day. But if you go out further, even just here to 80 days out, 170, that's only decaying 8 cents per day. So you don't get as much profit or benefit from the time decay if you go out too far, right? Plus, you're expanding your Vega exposure the further out you go. So we got to find a good balance. And since I was mentioning it, you could even go to this one, SPXW.X. And the nice thing about these index options, I'm not saying you have to trade them, but there's something you can look at. They are European style, which means they cannot be exercised or assigned until expiration. Now, because you're lowering that risk, guess what else you're going to lower? Profits, right? It's all priced in the options. Why would somebody want to choose trading the SPY's zero DTE options? Zero DTE, if you're not familiar, simply means that it's expiring that day. You know, we have options expiring today and tomorrow and Friday and Monday, Tuesday, Wednesday, Thursday, so on. You could choose to use the ETF, or you could choose to use the index options. Well, the index options may not give you as much premium, but you don't have the risk of early assignment. It's a trade-off. And by looking at this, if we can identify a range where the SPX is likely to finish today, we could potentially put on a position. And this is actually what I do on a regular basis. Actually, you'd have to go back a little bit in time, but there is a webinar again that was done on the zero D. Oh no, Jesus already showed it right there. Channeling the potential zero DTE strategies. When you look at those, you'll see that there is still premium available on that last day. Maybe not right now, it's getting late in the day, but there will be enough premium that you could potentially find a position and take advantage of it. So if we created a call condor or a put condor, doesn't matter, I would first start with analysis on the underlying security. And if we're looking for volatility, you can see right here, we have a scanner that's finding, first of all, liquid options. These securities have option open interest of over 10,000. The price is over $30 for the underlying security, so we can avoid penny stocks, right? We could do average true range is a little bit narrower than it has been. And if you go to the directions, when you download this workspace, it'll tell you what this is set up for. Right now, it is set up as, I believe I can see it right here too. If I go to studies and edit, and right now we're looking at 21 days. So the average true range for the last 21 trading days, it's basically 1 month, is lower than the average true range for the last 3 months, 63 trading days. Why would we do that? Remember, we are looking for securities that are starting to go in range bound. And if the average true range or the volatility of that security is starting to tighten a little bit, we're probably trading in a bit of a range. Makes sense, right? And then we have implied volatility is greater than implied volatility. What is that? Well, again, we're looking for the implied volatility right now to be above the average implied volatility. Even though we're ranging, if implied volatility is a little bit higher than average, we have the possibility of collecting a little bit higher premium. So it's a simple scan that was set up in the radar screen. This is built on the S&P 500, but we can also do this on hot lists. So there are two that are already built in. Obviously, it doesn't always show a lot of securities because it's pretty selective. We want to find the right ones. We don't need to find everything. So right now, this is showing the IV percentage hot list. These are the biggest implied volatility changes, but also that other screen I just mentioned. Well, CTLT, Catalan Inc. Look at that. That looks like a channeling stock, doesn't it? Between 59 and 60, right in that area. there might be an opportunity for a condor there. Now, obviously, I would also want to make sure there's no big events coming up like earnings that could spike the volatility, things like that. We want volatility to continue to decline, and you would do a little more analysis on that. There's also implied volatility change down, and of course, you can create additional hot lists and continue to use those scans to help find potential candidates to trade. So this is Amethyst. Yeah, look at that. Nice range bound security. Possibility for doing a condor or a butterfly. Now, with a condor, what should the market bias be? It doesn't really matter. You could create a bias by using either a put or call condor. If you have a put condor, typically you have a slightly bullish bias. If you have a bearish bias, you could use the call condor. What you'll notice is right here, if we create, and then right now I'm on the SPX, okay? So let's say I go to the SPX, and I'll go just to a normal chart, which of course I don't have. Let me see. Nope, not candle with trend, just candle. There we are. SPXW.X. Create that. Oh, just realized what time it is. I gotta wrap this up soon. And I'll cancel that. Let's see. We'll go to, yeah, this is today. You can see we're right now at about 55.92. We only have an hour left until the market closes. So this is not a good example. I would do this earlier to collect more premium. But let's say we expect to stay between 55.40 and 55.55. Okay, we could create a condor there. But if I expect prices to be a little bit more bearish, perhaps I do a call condor because then I might have a little bit of negative delta, just in case. Well, let's take a look at the pricing right now. Those expired today. I said 55. Oh, sorry, where was I here in the top range? Oh, no, it's 56.50. Excuse me, 56 and 55.50. So 56.50. We're not going to collect much premium, like I said before, but let's just do 25. Oh, hold on. Helps to clear the previous position first. There we go. And now I can bring in more strikes if I need to, but we're not going to get a whole lot of premium further out like that. VIX is up today, so the premium hasn't declined too much. That's good then. We might have a better opportunity. You know, I'm not going to be able to go to 56.50 because it's only nickel right now. So I'm going to go around 25. And again, I'm not doing the proper research. I'm just picking numbers just to show you an example right now. So don't try to copy this and put on a position. Education only right now. That's a 5-point spread, by the way. Could I do larger? Sure. Remember, my risk is going to be defined by the difference between the strikes minus the premium we're collecting. So if I do a 10-point spread, that's $1,000 of risk minus whatever premium I collect. If I do a 5-point spread, it's only $500 of risk minus the premium I collect. And that's also going to influence how much margin you have to come up with to be able to take the position. So on the downside, let's say we go to, I don't know, I can go, yeah, 55, 55.50. I did not go. There it goes, 55.50 and 55.45. There it is, Condor. We go analyze. And did that go right? Oh, no, there's a custom there and got to take that out. And you can see we're not collecting much. It's only $10 a premium with $490 of risk. It's not something I would do, but just to show you the example, that's all. $10 profit, $490 worth of risk. We have a delta that's a little bit bullish bias. Nope, there it is, negative bias. That's what I thought it should be. It didn't register right away. Because remember, I'm using the calls. So I should have a negative delta. My Vega is relatively low. We're basically selling time. And we're not collecting much profit, though, $10 altogether. But our risk is limited to $490 no matter what happens. And that is because we can't lose more than the difference between the two minus the premium collected. But that's it. So a few more things before we wrap up. Choosing expirations, yes, you could do 0 DTE, or you could do a little bit longer. You know, the longer you go, the more risk you expose yourself to on the volatility side, but you gain a little bit more time value, so you get paid a bit more. You got to figure out that balance of what you like. So some traders, if you're trading on securities, I showed you as the studies were going, you were looking at different stocks or even ETFs that fit into the relatively high volatility, but relatively quiet securities. You could use 30 to 45 days on the top side for a good balance between the two. But you could also do 0DT as well. I mentioned margin requirements, and I mentioned BPE, BPR. Any reason for that? BPE, buying power, you mean? Well, I mean, people were asking about what the margin requirements were, but yes, you do have to know what your buying power availability is for those securities as well to be able to make the positions. Absolutely. Why profit per day, not a main thing? I'm not sure what you mean. Why profit per day is not a main thing. I want to make sure that I can get a good rate of return. And profit per day is not necessarily something I worry about because you can't guarantee the profit per day. Oh, divide profit by the days out. Sure, I would look to see which options I'm going to choose based on theoretical value and how much type of return I should be able to get as well. And there's more condition lists in that education center that I mentioned for going into this. I'm just kind of scratching the surface, but there's more deeper education in that. One high volatility like 4 or 5 located on the daily time frame. Yes, I would prefer what you're referring to. Don's referring to a gauge where you take a implied volatility and compare it to historic volatility and divide it into a range. Yes, you'd want to have relatively high volatility for these types of strategies, but you can also get away with a range 3 as well and still collect enough. The other thing I would look at, which is really nice on TradeStation, I don't have it open right now. Watch this. Customized columns, implied volatility. I'm sorry, not implied volatility, theoretical value right there. Think about this. If we're selling, wouldn't we want to sell something that is being overvalued? Right now, the value of this option, 55.80, is only $11.72. That's pretty much right in line. But if I could see there's some sort of a skew where I could sell, let's say right now, I could sell this for, that's still within value. But if we go to some options, and maybe not on the SPX either, but when I'm choosing options to select for my trading, if I see that the implied volatility should be relatively high, but the theoretical value is lower than what I could sell it for. Yeah, right here. The theoretical value right now is 96.50, but this is selling for about 100. Why wouldn't you want to sell something that's overvalued? I wouldn't want to buy that for sure. So that's something else that can come into not just which option I should sell, but which series of options, meaning expiration, I might want to sell as well. So there are some other things. Also, when you put those in with condors, we're looking for out of the money expiration. That's the best case scenario. The options expire out of the money. You keep the premium minus any commissions or costs, fees you might have had to pay. If it doesn't happen, you can put in stop losses. Okay. Jesus did a really good workshop not too long ago. Again, it's available in the Options Education Center on setting stop losses and activation rules on your orders once you have a position in place. You can protect it with a stop. With the butterflies, you will often have to close out the position. You will have a slight bullish or bearish bias based on that delta that you choose and the strikes you choose, and you will have to close out the position for a profit prior to the expiration. Otherwise, you'll be assigned on one leg or the other because it's unlikely the prices are going to be right at your short strike at expiration. So limited risk, keep in mind, that doesn't mean no risk, okay? There is risk. We do benefit from volatility declining. A rise in volatility does hurt the position. And the underlying price moving beyond one of those short strikes does hurt the position as well, especially if it goes beyond the break-even price. Also, and this is some of the stuff you're talking about, buying power and margin, make sure that you're okay even if you were assigned on the position. So you got to make sure that your account can handle both the losses and the possible assignments that come with these types of opportunities in the markets. Okay. So as I mentioned this a little bit before, there's no set guideline. A couple things that you can look at is market sentiment. If you decide, the market might be going up, maybe you do choose the calls, although by selling some of those calls, you may have a bearish bias because you have a negative theta. A put condor might be slightly better in the bearish trends, although it could, because you're selling and not buying it, end up with a positive delta. So keep in mind the delta gives you an idea of which bias you might have. And before you place the trade, you can analyze it to see. You typically want higher implied volatility to collect greater premium, but you also would like to sell overvalued options. So you can take a look at that theoretical value, and the higher it is, the more likely you are to collect better premium. Yes, even 1 penny in the money will be assigned. Absolutely. Is really close price versus open price, in meaning when you close out? I'm not sure what you meant by that in the question. Liquidity is another thing that it basically, if it's not a very liquid option, you're gonna have problems getting the right prices. The bid-ask spreads will also be a bit wider. So make sure there's liquidity. I don't like to trade any options that don't have at least 10,000 in open interest, and the volume should be pretty regular as well, so you can get in and out. Buy options low, sell them high. Yeah, you can actually chart the premiums as well. I don't do that too often, but you could chart the premiums on TradeStation. Yeah. And here's one other thing I forgot to mention, put options. If you have dividends being paid out, I know we talked about earnings a little bit, but keep an eye out for dividends. Call options may not have as much of a change when a dividend's paid. Put options typically jump in price a little bit more when the stock goes ex-div. So remember, we want prices to decline, not necessarily too much, but a little bit. And the puts may be a little more sensitive to the dividend payments or ex-div dates. So you may want to choose calls if there's some dividends coming out, so you reduce that risk as well. Okay. Unfortunately, I got to get going. I did show you a little bit about the option space and about placing some of those trades and gave you some examples. If you have more questions, please let us know. I kind of ran out of time here, so I'm going to turn it back over to Jesus. There's a poll he's putting out here. I don't know if you, Jesus, want to mention anything about that before we go.
Yes, it's a poll about the webinar and what you thought about it. It helps us, guide our education topics. So please take a moment to answer the poll. We would really appreciate it. Brandon, again, great information. Thank you for, giving us these 60 minutes that were very, very insightful. So thank you for that. Everyone that joined us today, I want to appreciate your time as well. And as Brandon has pointed out, we have the Options Education Center with a ton of articles and, well, I would say a ton, but there's a very good collection of articles, a very good collection of webinars that I want everyone to go there and explore. I'm sure you'll find some very helpful there, as long as, workspaces and studies that you can bring into your TradeStation platform. Brandon, again, thank you for your time. Everyone that joined today, thank you also. Have a wonderful afternoon, and I'll see everyone in our next class. Thank you so much. Bye-bye.
Thank you for having me.